Good morning, traders and investors. My name is 𝗧𝗴𝗀, and I'm the Senior Strategist for WealthPress. Today is Thursday. It is August the 19th, and we are definitely, unequivocally, in the quietest time of the year. But there's a lot of stuff going on right now that we've got to talk about, and markets are setting themselves up for something. That's what I want to talk about today. Now, as you can see here, the market's going to open up in about a little less than 2 hours. I'm an early bird today. I wanted to get this nice and early to you before the market opens. As you can see here, the Dow is down a lot more than random. It's down 285 points. The Nasdaq is down 85 points, and the S&P is up 32 points. Now, if you look at the put-to-call ratio, which is a very, very important indicator that tells us whether bulls or bears are controlling the market, as you can see here right there, that is the highest volatility level. That's the highest fear level we had in the last 9 months. If you go a little further, you could see that volatility was higher back in October of 2020. October is the most volatile month of the year, and October 29th is my birthday. So that was the last volatile period. But since that time, volatility has been going down, and put-to-call ratio has been kind of calm. But whenever the put-to-call ratio goes, and let me just give you a good understanding of how it works. If put-to-call ratio is above 1, that means markets are scared, okay? If the put-to-call ratio is below 70, that means markets are overly greedy. Anything in between 70 and 1 is random. I hate to say it, but it is. So the only time these indicators, this indicator in particular, is useful is when it goes really outside of the norm. Like it goes down to these levels here, or it goes up to these levels here. So again, anything above 1 is telling us that the markets are scared, really, really scared. And typically when they get really scared, they turn back, they flip. And in this case, they're really, really nervous. And again, if we go below 70 to about 65, that means markets are extremely bullish. And right now, they're very, very bearish. And that's not counting. Remember, this is end of day data. This is as of yesterday. So right now, with the markets down 291 points, this level of fear should actually even go higher. The higher it goes, the more that rubber band stretches out and the more the market gets overdone. So this is an indication that we're fairly close to the bottom, which doesn't say very much because we haven't really moved much. But also, I hate to say this to you, but do you remember somebody telling you yesterday that volatility is set to increase? Volatility was right here, and now volatility is at 23. It was just yesterday morning in the video, in my morning video, that I said, folks, volatility is about to increase. We're about to hit a sharp pullback, and we're there. So in terms of global economy, the big report we have today is jobless claims and the Fed manufacturing index. We'll see if there's inflationary pressure and bottlenecks on the manufacturing level. As far as jobless claims, we're expecting anything below 400. And it would be great to see the number at 360,000. But the truth of the matter is the number has been going down pretty good. And anything below 400,000, the market will not look at negatively. The 4-week moving average is right around 400,000 anyway. So anything around 400, 380, 370, 400,000 or lower will not be used against us, if you will. So let's talk about global economy and talk to you about why the markets are doing what they're doing. Now, at least you know what they're doing. Now we can see why. But I told you yesterday, after I said volatility is, look at my video from yesterday. I said volatility is at pre-COVID levels and it's set to rise, and it's now rising. And I think there's a good chance we'll go a little bit higher before we cool off. In terms of whether this is going to be a major pullback or not, if you look at the equal weighted SPY, we're moving down to the 50-day line. And if you look at the broad market spot, the regular share weighted SPY, which I'm not a big fan of because it's got so much distortion right now, it looks like there's a good chance we'll hit the 50-day line. Whether we go to the twilight zone, which is the area between the 50-day line and the 200-day line, that's a question mark. But for right now, it looks like we're going to go to the 50-day line and kind of reevaluate what happens there. Now, let's talk about global economy and what's causing all of this volatility. U.S. central bank policymakers made no firm decision on when to unwind their support measures for the economy. Really, that's really interesting. I wonder why a year ago Jerome Powell was saying, we're not going to take any action until the end of 2023 or maybe even later. Now, we don't know when we're going to take... Man, it's best to keep your mouth shut when you don't know what you're going to do and when you're going to start unwinding, buddy. That's what I'm going to tell you. Stop telling people projections 3 years into the future. Not a good idea. That's my rant for the morning. The lack of directive from the Fed fueled worries. That's right, over surging COVID infections caused by the Delta variant and the pandemic's impact on consumer spending and job growth. Consumer spending? What have I been telling you about? Discretionary, consumer discretionary. Stay away from it, right? That's an issue. Minutes from the meeting released Wednesday indicated most officials thought it was appropriate to begin reducing the pace of asset purchases. And if it wasn't for this COVID flare-up, it would have already happened, or it would have happened in September, and it still may. The Fed's purchases were meant to lower long-term interest rates and encourage borrowing and spending, but what they really did was cause people to not need jobs for a while. It includes treasury and mortgage buying, which now amounts to about $120 billion per month. And if they stop or slow down the bond purchases, bonds are going to start going down and interest rates are going to go up. Chinese techs tumbled on fear of tightening regulations. E-commerce giant Alibaba Group shares sank. Internet giant Baidu fell as well. Keep your eye on the tech stocks. Now, the biggest factor today is this put-to-call ratio. I want you to keep your eye on the put-to-call ratio. And if it starts going higher, that means the market is going lower and there's more fear coming into the market. If we pass the level that we saw last October, that's not going to be happiness. But the market needs to shake out. And the reason the market needs to shake out, let me just show you this. And again, there's not going to be, for those of you who watch me every day, you're not going to learn anything new here, which is a good thing. As you could see here, and I've been talking to anybody who would listen to me, fragmentation. See technology? See consumer discretionary? They're typically next to each other. Anytime they're not, that means the market is overbought and it needs to cool off. And when it does, it cools off, all the stocks go back to their support level, and the sectors are not over fragmented once again. And that's what we're hoping for. We do have some stability in the market. You'll see consumer staples near material and utilities industrial. That's fairly defensive. Financial and real estate and healthcare. But technology and consumer discretionary being so out of whack, that's not kosher. All right. In light of that, I do have a couple of stocks for you. Now remember, the markets are choppy. Matter of fact, look at the number of stocks making 90-day breakdowns. 138. There's only 21 stocks making 90-day highs. The markets are fragmented and slightly bearish. And that's a good reason to avoid breakouts, pullbacks, and possibly short sides. So I've got a couple of stocks that I think will do well even in this type of economy. First is Restoration Hardware. Notice choppy, pulling back to the 50-day line. RSI is not overbought. Look at how much this stock has made over the last year, and I've been talking about it consistently. 112%. 5-year return, almost 2,000%. 5-year earnings growth, 555%. Earnings per share versus previous year, 285%. Furniture, luxury furniture, people are removing multi-unit family dwellings, single-family homes. And when people move, the first thing they do is they change their floors. I like this stock, and I like the fact that it's pulling back right now. And I think if it can hold these levels, we'll see an upside up to about 750 again. Next stock, United Healthcare. I like the choppiness factor, and I like how it's kind of just trending here. So even if it goes down, I don't think the downside will be extensive because the upside volatility was not. Remember, what goes up goes down. It's a double-edged sword in terms of volatility. So I like the stock. I think it's going to hit the 50-day moving average, but I like the levels, and it's not too risky of a stock right now. And last, I have a short opportunity, Humana. Double top, and the second top was lower than the first top. Double top, second top lower than the first top, breaking down below the 200-day moving average. When the market's at new highs, not very positive. And if this stock breaks down, if the market breaks down, this is a weak stock, it'll break down further. It's at a double top support level right here, the neckline, which is right around the 404. If this thing breaks, there's a good chance it'll go to 380. So I'm bearish Humana, I'm bullish United Healthcare, and I'm bullish Restoration Hardware. Keep your eye on the put-to-call ratio. Keep your eye out on the jobless claims and Fed manufacturing. If the Fed manufacturing data comes out weak, and if the jobless claims comes above 450, we may have another correction. Keep your eye on that put-to-call ratio. Now, the markets are really heating up right now. I've got something important, something you need to pay close attention to. Chuck Hughes, he's a former Air Force pilot, turned 10-time heavyweight trading champion and $1 million investor. And his brand new discovery, 𝗧𝗴𝗀, was triggered on SMH, ticker SMH, spitting out a perfect 0.01 rating. Now, if you want to learn more about Chuck's 𝗧𝗴𝗀 service and how his 0.01 signaled a healthy 107% profit opportunity, then be sure to click on the link below. Do not miss out on 𝗧𝗴𝗀. You do not want to miss out. This is brand new. Chuck's never done this before. This 0.01 stuff it's very important you guys understand it. Follow the link below and learn how Chuck signaled a 107% profit opportunity. Folks, 𝗧𝗴𝗀, Air Force pilot, 10-time trading champion, $1 million investor, 107% return on SMH. What's left there to do? Follow the link below. Get in on this now. And make sure to like this video. Subscribe to this channel if you're watching on YouTube. Folks, you got to stay ahead of the market by following my videos and being first to notified when I post my next video. How else are you going to learn about the put-to-call ratio? How else are you going to know about the volatility level, which I told you yesterday was going to start picking up? You're not unless you follow these videos. And make sure to check out 𝗧𝗴𝗀. Follow the link below. Do it now. Have a great day. Bye, everyone.